Time now for our Wall Street Week Daily segment with David Westin joining us right now with a very special guest. David, take it away.
Thank you so much, Romaine. Yes, we are joined by Larry Summers. He, of course, is a special contributor to Wall Street Week. He's a former U.S. Treasury Secretary and now at Harvard. So, Larry, thanks so much for coming back with us. We talked, it was only 2 days ago, although it seems like a lot longer ago, when we thought we were dealing with Silicon Valley Bank and a problem here in New York as well with Signature. But now it seems to have spread across the Atlantic. Now, I know you do a bit of work with Michael Klein, although not in the Credit Suisse deal. But do we have a systemic problem that's growing?
Look, Credit Suisse has had profound issues for a long time. It had a whole set of reversals. And so there's probably an element of contagion in this, but I think the larger part of it is just multiple problems coming together in a stream. And that's certainly a complex and difficult situation, in many ways a much more complicated one than SVB, because Credit Suisse has complex global operations. There are multiple jurisdictions of regulation that are involved in dealing with it. So that's clearly something that is going to require attention, and I would assume that the regulatory authorities are in consultation with each other, in consultation with management about the way forward with respect to the Credit Suisse situation, which certainly appears to have affected the valuations of major institutions globally, and appears to be impacting significantly expectations of the future path of interest rate policy.
But do we have a financial stability problem at this point? Are you more concerned about that today than you were 48 hours ago?
Yes, I think that as more and more companies are caught up in this, the complexity and extent of the solutions that are required goes up. Look, this is the kind of thing that the authorities have been planning for since 2008. That's what orderly resolution and all of that is about. That's what capital that can be bailed in is about. That's what larger quantities of capital and liquidity requirements are about. And in a sense, we're facing the first tests of the new regime. And the new regime didn't do so well with respect to SVB, in the sense that it was necessary to ad hoc a whole set of new arrangements on top of the new regime. And we're going to have to see what works out at Credit Suisse.
Larry, do you think it's time to take a fundamental look at how we capitalize our banks? Not just the level of capital, but how we capitalize them. Obviously, we saw at SVB and some other banks some issues with some of those long-term securities.
Yeah, I think there's a whole set of questions in the banking industry about how we treat the so-called treat longer duration assets. What should the role of market values be versus the price people paid for an asset that may have changed substantially in value? I'm not sure we're thinking about that right in our regulatory regime. We've traditionally assumed that deposits were a fairly long-term asset of banks against, or liability of banks against which they could hold a long-term asset. Well, deposits are looking a lot less sticky today than they were looking 2 weeks ago, and that's going to require some fundamental rethinking as well.
Larry, we have obviously two central banks trying to deal with inflation, the ECB that we will hear from tomorrow and the Federal Reserve we'll hear from next Wednesday. Do you think the central banks in Europe and in the United States are going to have the courage to stay the course given how quickly this story is developing? And perhaps more important, should they have the courage to do that?
I hesitate to make any of these judgments in advance of when the institutions need to make their judgments. I think if institutions don't focus on their inflation mandate, they will be making a very serious mistake. And if they appear to be abandoning concern about inflation, they will make a very serious mistake. On the other hand, I think there clearly is a disinflationary impulse coming here from the reductions that are likely in the flow of credit. And in a sense, that means that monetary conditions have tightened without an increase in discount rates or federal funds rates or their European equivalent. And so I think what central banks are going to have to judge is the scale of that disinflationary impulse. And I'm not sure what the right way to come down is. In the United States, I would assume that 50 basis points for March is now off the table, and I think it probably should be off the table. But I would be concerned if the situation was judged such that they couldn't do 25 basis points, that would be sending a very ominous kind of signal about how the central bank sees this situation.
Larry, you've been in decision-making positions at the U.S. Treasury and then at the White House, actually, in the 2008-2009 crisis. So you have a sense of how this works. Is it conceivable that Christine Lagarde and Jay Powell are not even coordinating on this? Because it strikes me as very unusual if, for example, the ECB decided not to raise tomorrow. Doesn't that preclude the Fed from raising next week?
I don't think the effects are that large. I'm confident that the institutions are in touch with each other and are trying to make sure that they each understand how the other is moving. Of course, they have to make their decisions ultimately with respect to their mandates, which focus primarily on their national economies.
Larry, what about the possible effects in, I'll call it the real economy, the ecosystem, particularly when it comes to innovation and startups in the United States? Obviously, this started really with Silicon Valley Bank to some extent. And to what extent is this really going to affect the willingness to take risk, to have innovation, to fund that innovation? Because this has ripple effects throughout the entire ecosystem, particularly in California.
I don't think this is going to be the biggest problem for the tech ecosystem. Yes, there were many institutions that were close to Silicon Valley, but we sort of learned a painful lesson about loyalty from the number of venture capitalists who urged their portfolio companies to pull their money out of Silicon Valley Bank as rapidly as possible. We learned that whatever these great relationships that Silicon Valley Bank had were, other banks were not prepared to pay a lot to have the opportunity to take over those relationships. I suspect that holding cash for payroll, being prepared to make advances on money that's coming in from your venture capitalists, I think these kinds of things will get rewired before too terribly long. And so I think the real issues for Silicon Valley are going to have more to do with the possibility that there may have been a bubble element in tech valuations, more to do with the consequences of the broader business cycle, the consequences of higher real interest rates. My greater concerns would actually be with the consequence of diminished credit creation broadly by regional banks. And at a time when commercial real estate, particularly office buildings, is facing stress, that the reduction in the willingness to provide credit, both directly and to funds that are in the business of providing credit, could have larger consequences. That's the disinflationary impulse I was referring to.